So if the photographs are done, then we can probably start. I think let's just let them take the photographs and then we can start. Okay, done? Thank you.
Thank you, sir. Hello and welcome to this post-policy conference. It's good to see all of you here in RBI premises after a long gap of 2 years. And I hope everybody has been keeping safe and healthy. So without much ado, I'll introduce, we have today 20 media participants in the press conference. And with your permission, I'll begin the press conference. I'll call out the names of the persons. They will ask the question and then we will respond from our side. If you'd like to say some initial remarks, then yeah, please.
I think इसको हटा देते हैं. Good morning. We are actually delighted to have all of you here after a gap of 2 years. We are having the first, face-to-face press interaction. So we are very happy that all of you have been safe. And so I would like to mention that that gives us a lot of satisfaction. And hopefully we will be able to continue this practice, which we are restoring back to the normal pattern that we followed earlier. Now, the statement today which I made, there are a few things which I thought I would just explain in the beginning for the sake of clarity and also to put things in the proper perspective. There are 7 things from the monetary policy point of view. There are 7 things which we have done, and which I think it is all there in the statement at various places, but I'm just putting them together. The first is that we have revised our inflation and growth projections. And if you look at the inflation projections in particular, which I think which would attract a lot of attention. If you look at the inflation projections, primarily the projections have been revised upwards due to war-induced factors. The primary reasons are the crude oil having gone up to 100 in 20 to 130, as I had mentioned, then they have moderated, but we have assumed a price of $100 per barrel. So that is the most important reason. And among the other major reasons, the price of edible oil, which is again, edible oil prices have steepened. Again, that's due to war-related factors. I've spelled out the details in the statement. I don't want to again go into that. Edible oil, prices of wheat also have gone up because that is related to war. And the feed cost, which feeds into the prices of poultry, egg, and dairy products. So these are the major factors for which account for the upward revision of the inflation. So inflation and growth projections have been revised. That's the first point. The second point is that in the sequence of priorities, we have now put inflation before growth. So that is the sequence of our priorities. First is inflation, followed by growth. For last 3 years, starting February 2019, if you remember, we had put growth ahead of inflation in the sequence. This time we have revised that because we thought that the time is appropriate and that is something which needs to be done. That was the second point. The third point is that the stance continues to be accommodative while focusing on withdrawal of accommodation. So we are gradually, therefore, moving away from the accommodation, which has been again, which has been there for more than 2 years. In fact, somewhere in the middle of 2019, we had switched over from neutral to accommodation. The fourth point is that the LAF corridor has been normalized. The corridor is now 50 basis points. 25 basis points on either side of the policy repo rate, which is at 4%. The fifth point is that SDF has been introduced, and SDF will now be the bottom of the corridor. The sixth point is that we have said with regard to liquidity, the liquidity withdrawal will be done in a multi-year time frame. We have mentioned multi-year time frame after very carefully weighing what would be the economic cost of withdrawal of liquidity, and what would be necessary keeping in mind the stance of monetary policy. So the liquidity policy, the liquidity withdrawal will be taking these two factors into account. We have said it will be done on a multi-year time frame, and a multi-year is obviously more than 1 year. So it can be 2 years, it can be 3 years. That will depend on the evolving situation. If there are questions, we would like to elaborate upon it later on. And the seventh point is that I have said in the statement that the situation is dynamic and fast changing, and all our actions will be tailored accordingly. Situation is really fast changing between February and now. You saw what kind of developments, what kind of tectonic shifts, that is the word I have used in my statement, what kind of tectonic shifts have happened all over the globe. So I will stop here. These were some of the initial remarks which I thought to just put into perspective what is there in various parts of my statement. Thank you.
Thank you, sir. To start with, I'll invite Mr. Govardhan Rangan from Economic Times to ask his question.
Good afternoon, Governor. So thanks for bringing us back here after 2 years. It's good to be here. You mentioned that you already started gradually withdrawing the accommodative position. And we could see that in the statement also that you have replaced continuing with remain. So there is a kind of a signaling that the next step could be moving to neutral. Is that what the signal is in terms of after having increased the inflation forecast by almost 120 basis points? And also the SDF. Why an SDF now? Is it to allow non-banks also to participate to address the liquidity issue? Thank you.
Non-banks, there is no proposal as of now. There is no such proposal, but I would think that let the press conference be participative. As you can see, I have all the deputy governors of Reserve Bank with me, so I would request Deputy Governor Dr. Michael Patra, to take that question.
So first of all, why withdrawal of accommodation? As you know that we had taken the policy repo rate to an all-time low, which is 4%. If you adjust it for the target, then the real policy rate was 0. Now that was ultra accommodation. Now that the situation is changing and inflation particularly is at risk, we want to withdraw the ultra accommodation. But we still have scope to remain accommodative. On the SDF, why the SDF? We chose to introduce the SDF from a position of strength. To give you an example, now we are absorbing liquidity because of government spend, and government is in ways and means. That is the magnitude of the shift. So as you can see, it was opportune to introduce it now. Going forward, it prepares us for both sides of the situation. One, as you are seeing right now, we are absorbing huge amounts of liquidity. Suppose the situation changes and the war ceases and India becomes a preferred habitat of capital flows as it was in the year before. This enormously increases the capacity of the RBI to sterilize those flows and keep monetary expansion in check.
Thank you, sirs. I'll move on to Lata Venkatesh from CNBC-18.
Yeah.
Governor, your last statement was that the objective is to restore the size of the liquidity surplus in the system to a level consistent with the prevailing stance of the monetary policy. So does it mean the monetary policy becomes neutral only when liquidity becomes neutral? That's the question. I mean, that occurred to me when you said the seventh point. But my other question was, you are perilously close to crossing 6% 3 quarters in a row. Already April, Jan, Feb, March is above 6, and by your own forecast, this April, May, June is 6, and the next quarter you all have a forecast of 5.8. It doesn't take much for it to become 6. So then what do you do?
We are watchful. The last point which I mentioned in my opening remarks is that the situation is dynamic and fast changing, and all our actions will be tailored accordingly. And all instruments are on the table. So we are watchful of the emerging trends, how the war progresses, how the commodity prices and the crude oil prices, how they behave in the coming months. And accordingly, whatever action is warranted, we will take them, and all our actions will be tailored accordingly.
All your action, will you even ask for a change in the monetary framework excused for one?
No. When I say, that is a very hypothetical question.
I'm asking you what you mean.
What we have is that you said that we are perilously close to breaching the, the target. That is 3 consecutive quarters if it exceeds 6%. We are watchful, and we will take whatever action is necessary at the appropriate time. And I think the broad thrust of the monetary policy and the statement is sufficiently clear. So the RBI will act as per the emerging situation.
Thank you, sir.
Is there anything you would like to supplement to what?
So on the stance, you said liquidity will be in consonance with the stance. So does stance become neutral only when liquidity becomes neutral?
Does stance become?
Neutral only when liquidity becomes neutral, because now liquidity is surplus.
No, again, liquidity becoming neutral, it's dependent on so many factors. It will depend on credit absorption, credit growth also. It depends, as the Deputy Governor pointed out, on the pace of government spending. It depends on capital flows, inflows and outflows. So therefore, I would not like to sort of, at this point of time, freeze my options. I would like to keep our options open, and considering all these variables, we will take appropriate action.
Thank you, sir. I'll move on to Ms. Ira Duggal from Bloomberg Queen.
Good afternoon, sirs. My question is on the liquidity framework. If you can just give us a little bit more clarity. There are now 4 rates. Firstly, what is the utility of the fixed rate reverse repo? Why have we kept that there? I think even the Mohanty committee had, correct me if I'm wrong, had recommended a 3-rate framework. So now that the STF has been activated, keeping a reverse repo at 335, STF at 375, does it not lend itself to more volatility, particularly in the short-term markets, sir?
I think you can take that question.
Yeah, the fixed rate reverse repo is there because, as the RBI stated policy, is that there is no instrument which we take off the table. But we have specified that it will not be for everyday use or for liquidity management. It will be there for purposes which we will decide from time to time. The liquidity management will effectively be with the LAF, and the LAF has 3 rates: the MSF, the SDF, and the repo should be at the center. So we are getting back to that system. In the process, the reverse repo is kept there because it has no use for the liquidity management as of now. But we will, if we find a purpose for it, we will announce it and use it for that purpose.
Effectively, sir, theoretically, in a liquidity surplus scenario, the STF rate is the operative rate, or the VRRs is where the effective short-term rate is.
That's right.
Thank you, sir. I'll move on to Mr. Mayur Shetty from Times of India.
Sir, on the liquidity framework again, what was the reason for not using the reverse repo? Is it because it goes against the accommodative stance, or is it because it's collateralized?
You see, SDF gives us greater flexibility in implementing the monetary policy objectives. It is uncollateralized, and we are not constrained by the we are not constrained by the stock of liquidity that we have or we don't have for various liquidity management operations. So it gives that much more flexibility to the Reserve Bank. And if you recall, I had said in my statement also, it is thereby, consequently, it is also an instrument of financial stability. It enables us to sterilize, it would enable us to sterilize liquidity if there is excess build-up due to various reasons without the constraint of collaterals. So it gives us flexibility. It enables us to strengthen financial stability. It's also an instrument of promoting and strengthening financial stability.
Is it also signaling of the stance? Will it get revised when the stance changes?
So which one?
The reverse repo?
No, reverse repo at the moment remains at 335, and as was explained by the Deputy Governor, when we see a need for it and if such a situation warrants, we will at that time probably consider and activate it.
But the stance
But-
has changed to, like you all are saying that you're getting into a withdrawal stance. Would the reverse repo change when you start withdrawing the
That is a hypothetical question. I would not like to. Let me make one thing clear. Repo rate, which is decided by the MPC will decide the repo rate from time to time in the MPC meetings. Now that the corridor is normalized, once and if the MPC decides to increase the repo rates, then both the other rates, MSF and SDM, will move in tandem. So, rate action, that is policy repo rate action by the MPC, will now be accompanied by concomitant revision of the SDF and MSF rates. So that is the sum and substance of what we are saying.
Thank you, sir. I'll move on to Mr. Anup Roy from Bloomberg.
Thank you, sir. Thank you, Governor. Sir, there were some criticism that RBI was behind the curve, etc. Now, with this kind of hawkish policy, and and actually nobody, not many expected that you will bring down growth estimate to 7.2%, maybe maximum 7.5%. Why this? How do you explain this aggressive stance from the RBI's perspective?
Now, hawkish or dovish or whatever is a media formulation, I will not like to enter into that. And this whole debate about behind the curve, I think it again depends on who is drawing the curve and how he is drawing the curve. But on a more serious note, I don't think the RBI is behind the curve at all. I have said it on a number of occasions. In fact, in a recent event also, I have said that. Very often, India's monetary policy action is compared with what the advanced economies are doing. Please remember that advanced economies are still on a reduction of their what you call the bond sale program. The bond purchase program. I'm sorry. They are reducing it. They are phasing it out. We stopped GSAP last year in October. We have not done GSAP after that. If you see our actions with regard to outright OMO, not Operation Twist, but outright OMO, they have been far less, and not despite that also the yield curves have sort of moved in a particular manner. So therefore, that is with regard to the liquidity. Now, with regard to the rates, we have been very watchful. And the February policy, we had given a certain roadmap for inflation. All the factors and all the risks we had calculated at that time factored in, and we had given a particular roadmap. War was something which was a development that started on 24th February, and whole of March it is still continuing. And concomitantly, all that has happened all around the world has introduced a completely new element into the scheme of things. So therefore, we have revised the inflation projections, and I have said that we are ready to take whatever action is required. I have said, in fact, if you read the statement carefully, in my statement. I have said that it's towards the end. I have said that inflation, growth, and financial stability. It's in the last, I think it's in the concluding part. I have said inflation, growth, and continuity. These are all interlinked, interdependent, and the RBI will deal with them. But please see the sequencing. Go ahead, please add.
Anup, I just wanted to sound a note of caution that when you use the term behind the curve, maybe you should look at the origins of where it came from. And I found that it is actually the name of a documentary film on people in the United States who still think that the world is flat.
Thank you, sirs. I'll now move on to Mr. Manojit Saha from Business Standard.
Thank you, Governor. Do you expect banks to respond by pricing their risk appropriately now that you are no longer ultra accommodative and just only accommodative? And what is the real rate of interest you see for the economy going ahead? Because at now the negative real rate is about 100 basis points, taking 1 year ahead inflation forecast.
You see, the banks will do their risk pricing. Whether they will do it, how much they will do it, I can't say really. I mean, it's for the banks to decide. In fact, it will not be correct for me to sort of in a public forum say how the banks, whether the banks will do and how they will do their risk pricing. It's purely a judgment, a call on the part of the banks, and they will take it. And what's the second question you said?
What is, in your view, what is the real interest rate you see? Right now it is negative, right now it's negative 100 if you take 1 year ahead inflation forecast. Real rate of interest.
I think real rate of interest, neutral rate, all these concepts, there is continuing research. A lot of research has been done and research is continuing. And I would request our in-house expert, the Deputy Governor Michael Patra, if he wishes to, say something on this.
Yeah. So for a developing economy, which has potential to grow, the real rate of interest should be positive. Okay. But that was the state before the pandemic. In the pandemic, that state was abandoned by almost every country in the world, and people all over the world took interest rates down to even negative levels. Around that time, the fix that people got on the real rate was 0 or minus. Now it's, I think, premature to work out a real rate of interest. There is not enough data points. But I think what has been amply explained by Governor is that we have started a process, a focus on withdrawal of accommodation. That is the path back towards a positive real rate. So it's a dynamic situation.
Thank you, sirs. I'll move on to Mr. Bijoy Edicheria from Informist Media.
Hi, sir. Bijoy from Informist here. Sir, one statement conspicuous by its absence is the statement that you have always said that the orderly evolution of the yield curve is a public good at a time when you are moving on at least the LAF corridor and there is such a large government borrowing program on the anvil. Do you think that it is time for the RBI, which was trying to guide rates, to now stop doing that because there are just too many factors globally and domestically playing out that prevents RBI from playing a material role in trying to prevent a runaway increase in yields?
You see, orderly evolution of the yield curve as a public good. Now, whatever is a public good in a certain situation is a public good forever. I mean, we do not define public goods. Today it's a public good, tomorrow it is not a public good. Orderly evolution of the public good is important. And we will be watchful of the yield curve. We will be watchful of the implementation of the government borrowing program. And I have said also that the RBI will use various instruments from time to time for successful completion of the government borrowing program. One measure which we have announced today relates to the HTM, where we have increased the HTM limit from 22% to 23%. If you recall, it was originally 19.5%. In COVID situation, we increased it to 22%. We have now increased it further to 23%. And we have also said that the securities government securities to be acquired from now till 31st March 2023, that will also be eligible to be counted under the HTM. So we have taken a first measure. We will remain watchful, and whatever measures are required, we will take them from time to time.
Thank you, sir. I'll request Mr. Shayan Ghosh from the Mint to ask his question.
Hi. So we have seen some KYC issues at some of the entities which are regulated by RBI, where customers found out they have loans without having taken them. So specifically with regard to these entities, has RBI taken any action or is planning? And secondly, generally about these KYC and privacy issues, what is RBI's thinking on how these issues could be mitigated in the future?
I would request, I think, Deputy Governor Rajeshwar Rao to take that question.
No, wherever we have seen the cases where this kind of irregularities have happened, we are looking into it, and based on the outcome of an investigation, appropriate action could be initiated. As regards the KYC issues, there are certain operational issues also in the KYC. We are engaging with internally also we are looking at the KYC issues, and if required, we will look at what kind of amendments are required for the regulations and make it simple, but at the same time effective, and address the concerns around the KYC on an ongoing basis. So we will be looking at that issue.
And KYC